All right. Good day, everyone. Good morning. It's an absolute delight to have you here this Wednesday morning. And of course, for Nigeria at Mid-Year 2026, navigating economic reforms, market opportunities, and the outlook for this half of the year. My name is Onyechi Owumbu, and I have the honor of being your host today. There is so much to look forward to today, and you want to be well positioned for all that's ahead. So much has happened in the first half of the year. Where do we even start from? We kick here bracing for a global monetary easing cycle, only to be hit in March by severe geopolitical tensions that led to a major energy supply shock, which we are all evidently still recovering from. Here at home in Nigeria, resilience has been the underlying theme. We already have the NBS, the National Bureau of Statistics, come out with eased inflation headline for June at 15.91%. However, food inflation still remains at over 17%. CBN has set its foot firmly on the brake on the MPR. So are we locked in for higher for longer rates? Is the equity market on its way to rebound? Are tensions easing in the geopolitical space, or is the reverse the case? This webinar is brought to you by FCSL Asset Management. And to help us untangle these interesting questions and themes, we have an amazing line of panelists. So please help me welcome our speakers. First, we have Andrew Essene, who is the head of corporate finance and research at FCSL. He's bringing nearly 2 decades of experience in corporate finance and advisory, and honestly, an all-round market expert. And then we have Jonathan Ohimai, who is a research analyst with strong passion, I do say so myself, for global market and macroeconomic trends. Finally, we have Favor Oluwayale, our money market analyst specializing in money market instruments, liquidity management, and the fixed income market analysis. Once again, thank you all for being here. To our audience, please feel free to engage with your reactions, drop your questions and comments in the Q&A tab. We will get to that session towards the end of the webinar, and then let's just jump straight into it. We are not here for a long time, but it's definitely going to be a great time. So I want to start with Jonathan. Hi, Jonathan. Good morning. Let's start with you.
Hi, Olivier. Good morning.
Thank you for joining. We're happy to have you here. But before we discuss where we are headed, it is important to know where we've come from. So to set the context, let's begin with the global landscape before we bring the conversation home to Nigeria. The start of the year, there were several projections for 2026, particularly around geopolitics, global trade, the outlook for the world's biggest economies, US, China, Russia. However, it's clear that things have unfolded quite differently from what many of us anticipated. So can you help us make sense of that and share your perspective on what this could mean for the global economy in this second half of the year?
Oh, thank you very much. Be happy to do that. The global economy in the first half of the year, just to give you a review of what the first half of the year looked like, before talking about the second half of the year. The global economy in the first half of the year was, largely defined by, geopolitics and the risk that, come from it. To take a step back to know where we're coming from, in 2025, the world experienced, a major shock around the trade tariff and then the trade war that happened between, the US and China, as well as the US and its other trading partner that largely, shaped, the outlook for 2025. Coming into 2026, our projection was that we would see, an easing monetary policy and the disinflationary cycle, which would, catalyze growth in the global economy. In fact, the World Bank had already, projected that growth was going to be about 2.8% in 2026. But all that outlook were largely, thrown out of the window when in February we saw the conflict between the U.S., Israel, and Iran, which largely cut off the supply of key commodities that keep the world running, and one of that being energy. So we saw a closure of the Strait of Hormuz, so which led to the supply cut of crude oil, supply cut of oil, gas, and also supply cut of key commodities like fertilizer. So what the world experienced, from that time to June, which was the half of 2026, was an increase in the in global inflation. So we saw oil price went up, fertilizer went up, and this resulted to a shock in the global economy. We saw investors, selling risky assets, moving toward cash. We saw people moving into gold as a safe haven asset. We saw foreign investors taking their money out of, emerging markets that are, net importers of petrol. As a result of this, we had to change our outlook for 2026, especially half year of 2026. And our outlook is largely based on two scenarios. So we have a base case scenario and we also have a worst case scenario. Now, a base case scenario, just to put context to this, the two outlook are lying on the back of geopolitical tension. So for the base case, we expect geopolitical tension to ease in the Middle East and for the Strait of Hormuz to be open so that trade can continue, movement of commodities can continue, and that would lead to a steady disinflationary path, which would catalyze growth in the global economy. And our worst case scenario is that we expect we think that if this war continues, which as of today, the US has just announced that it has conducted its 11th strike on Iran, following some of the key personnel that were killed in the Iran strike on their Jordan base. So we expect that inflation continues to surge on the back of escalated conflict, and that would lead to a major change to a lot of economies. The EU is largely struggling and at the brink of stagflation. The US, inflation in the US has gotten to about 4.2%, down to about 3.8% in June. So, on the back of this, we think that energy prices would literally destroy, for lack of a better word, a lot of economies. So, for economies like the US, just to speak a little bit about it, in H1, was resilient, and that was largely, on the back of the AI investment as well as a strong consumer demand in the US, um, and the a resilient labor market. But inflation in the US, went as high as about 4.2% before coming down to about 3.8%, which led the Fed to keep rates at current levels. Also citing the risk of higher oil prices that would lead to a possibility of a rate hike in the US. But the EU has always had a target, an inflation target of about 2%. But due to the war in the Middle East, inflation surged largely above that 2%, and that led the EU to hike rates to about 2.25%, and this is the first time they are doing this since 2023. To show you how a lot of central banks are now reacting to this new and ever-changing geopolitical macroeconomic condition. The EU, growth in the EU also analyzed around 0.3%, largely on the back of weak industrial activity and elevated energy prices. Sub-Saharan Africa, was not left out. Although I think one of the key things we can say, about the Sub-Saharan Africa economy is the softening inflation that we've experienced in 2025, easing policy that we've seen in 2025, and a stronger investment activity that happened in 2025. In fact, growth, outlook average about 5.29% in Q1 2026 to show you how interesting, Sub-Saharan Africa had been. But, because of the war and on the back of, higher energy prices, that outlook largely changed. We've seen Ghana that moved from a double-digit inflation in 2025 to about 3.34%, now struggling with currency devaluation. Same with Angola and other key economies. And we largely think that the base case scenario that we have for the global economy applies to each of these three economies that we've spoken about. We think that the as we continue to see diplomacy in the Middle East and the a smooth passage of ship carrying key commodities like crude oil, like fertilizer, would start to see a disinflationary trend, which would largely lead to uh, a rate cut, and in turn spark growth in various economies. Um, but in a situation whereby that's not possible, then the outlook is really, really, cloudy, for a lot of economies as the central bank, look to navigate, this economic conditions. So in summary, I would say, two base case scenario. We have the base scenario as well as the worst case scenario, and then we think that right now the world is largely tending towards the base case scenario because of the steady disinflation or steady reduction in energy price that we've seen recently. Thank you.
Okay, thank you so much, Jonathan, for that review. And obviously, we are not out of the woods yet when it comes to the geopolitical tensions. Even so, more recently, energy prices have started climbing back up again. So, fingers crossed on that end. You mentioned the CBNs of various countries. So I still want to stay with you, Jonathan, because I want us to bring the conversation home to Nigeria, an oil producing nation navigating rapidly evolving economic landscape. Can we take a closer look at some of the key indicators for the economy in Nigeria? We're talking about inflation, GDP, exchange rates. And as I mentioned earlier, CBN and MBS released some interesting figures, but beyond the headlines. Can you unpack the story the indicators are telling about the Nigerian economy and how this is likely to affect the average Nigerian?
All right, thank you very much, Amy, for that question. For the Nigerian economy, we in 2026 we expected the Nigerian economy to build on the wins that achieved in 2026, and transition into a stronger and more sustainable growth phase. But on the back of the geopolitical tension, like I said, for the global economy, we are coming from a place. Note, we're coming from a place where Naira was largely unstable, reserve were, at an all-time low, and inflation was galloping. In fact, we were coming from a place where inflation was about 34%, although rebased, but inflation was about 34%. And the equities market, like it was right now, didn't have that level of traction that it had. But all this change, on the back of reforms, and then part of those reforms are, the FX reform that happened, banking recapitalization, and all this that, has proven to, put Nigeria in that space where it can conveniently grow. Currently, we think that even though inflation looks fragile at the moment, so the last number printed was about 15.93%. Currently, we're talking 15.91% in June, and uh, even though this number looks fragile, businesses can now make investment decisions, right? We've seen a lot of that happen in 2025 and even in 2026. A lot of capex spend, a lot of business expansion, happening. And this investment, has also reflected in our GDP numbers, printing about 3.89%. In an economy where we have like huge, elevated interest rates, we're printing about 3.89%. And if you compare that number to Q1 2025, where we had 3.13%, you agree with me that that's a good a good increase. And this is largely on the back of the growth we've seen in the oil and gas space as well as in the service sector. Uh, but global rating agencies they've also expressed their positive sentiments towards Nigeria. We've seen the FTSE resale indicates their position of including Nigeria back into their index. We've seen the S&P Dow Jones indicate its interest of putting Nigeria back into their own index. We've seen rating agencies, increase their or boost the rating for Nigeria, and also the removal of Nigeria from the FATF, blacklist. So all these are positive sentiments, from a macroeconomic, point of view, and as a result, we've seen, increase in our reserve. To about 51.8 billion from a 45 billion naira approximate levels in 2025. And of course, this is also on the back of FPI's diaspora remittances as well as oil receipts, which has helped stabilize the naira. I think one of the key things or one of the key wins that Nigeria has experienced is the increased investment that has happened in the oil and gas space, and how that has catalyzed growth for the general economy as well as growth for the oil and gas industry. We've moved from a level where you know oil production was averaging about 1.2 million barrels per day in 2023 to a level where oil production is now averaging about 1.6 million barrel per day. And you would agree with me that with this higher oil price that we're seeing, that has gone over the roof, that's some good FX revenue coming in for Nigeria as a country. Um, how do all this make sense to you as an investor? I think one of the key questions in the mind of every investor is return on capital, as well as return on the investment. So capital preservation first, then the return on that investment. And Nigeria has shown to be very investable. I know some of us on this call are investing in the Nigerian capital market, and to interest you to know that even if you're not interested, even if you're not investing in the Nigerian capital market, just holding the naira as opposed to the dollar, you would be up about 3.3 percent year to date. So that's a good signal, and our outlook basically for Nigeria still lies on the back of geopolitics, diplomacy in the Middle East. We expect in the inflation pass through to ease, as we see energy prices start to drop, making the equities market attractive for investors as well as margin for businesses continue to expand. But this is our base case scenario. Like I said, our worst case scenario is that we see this geopolitical tension continue, and how that capital crystallizes a capital flight, and also making the equities market less attractive, as we've seen in the month of June, where the fixed income market was averaging yield of about 18-17%, and that just took a shine out of the equities market. But from an economic stability point of view, I think that we're largely stable as a country. and because of the reform, that we have seen. So I think that, for investors, I think Nigeria is largely stable. Thank you.
We hear you, and I agree with you that the Nigerian economy is still very resilient. And yes, a lot of positive sentiment about the economy, and it's still very much attractive to foreign portfolio investors. That was incredibly insightful, and you've given us a comprehensive overview of both the global and domestic economic landscape. Thank you very much. But let me bring Favor into the conversation. Good morning, Favor.
Hello, Onye. Good morning.
Good morning. So, Favor, Jonathan has helped us understand the broader economic picture, but I'd like to go a level deeper and focus on key institutions such as the federal government of Nigeria, the Central Bank of Nigeria, the Debt Management Office, how they have responded to these economic realities, and how are they managing the key indicators, the liquidity in the system, inflation. What are we currently seeing in the market in terms of yields? And what should investors expect over the next few months?
All right. Thank you very much, Onye. Thank you everyone for joining us today. I'd also like to thank Jonathan for the insightful presentation. And this has provided a backdrop to what we'll be discussing in the fixed income market. Now I'll be taking us through the fixed income market review for the first half of 2026. We'll be highlighting the key developments that shaped both the global and the Nigerian fixed income market, and what this actually mean for the outlook that we are expecting in the second half of the year. So now I'll begin with the global fixed income environment. We want to see the developments in the global inflation, in interest rates, and also geopolitical risk. How this continues to influence how investor sentiment and also the inflows we saw into the emerging markets, especially Nigeria. Now, in the first half of 2026, we saw that global yields surged really high. We saw across global economies, we saw yields going close to 5%, especially in the United Kingdom. And like Jonathan has mentioned earlier, geopolitical tension has been something that driven the market for quite some time now. And the tensions slipped into higher energy prices, which also watered down to inflation rates. We saw inflation rates that we expected coming into the year 2026 to go down. We saw them going up again at the beginning of the year. So like I said earlier, energy prices went really high, and this pushed inflation higher. And because of this, we saw central banks adopting a really cautious stance. Rate cut expectation became reduced, and this had really caused a bearish sentiment in the market. So going into the second half of the year, we expect that this same bearish sentiment will continue. Because of the resurgence of the US-Iran war, we are seeing that oil prices are beginning to go back up, reverse its position from late June, and this will definitely slip into inflation rate. Inflation that started marginally going down will start to pick up going into the second half of the year. So we would advise that investors should remain cautious about extending their portfolio duration, especially in terms of their duration risk. Longer term fixed income securities are particularly vulnerable to further increase in bond yields. And especially if we see that the inflation rate still remain persistently higher. Now, against this global backdrop, let's look at what exactly happened in the Nigerian fixed income market. We saw elevated yields and also really robust system liquidity in the market, and this kind of continue to support strong participation from investors, despite the fact that going into the year we saw a tight liquidity sterilization from the Central Bank of Nigeria. Now, let's start with the system liquidity. We saw that the liquidity conditions in the economy was largely influenced activity across the money markets and most especially the Nigerian treasury bills market. Now we saw that liquidity was really robust at the beginning of the year, and even that slipped towards the end of the first half of 2026, despite the fact that we saw that the CBN was carrying out really aggressive sterilization of the system liquidity. We saw the CBN withdraw as high as 13 trillion naira. That was towards the end of January. And this really seeped into system liquidity. However, we saw really large amounts from maturities in the OMO space, in the treasury bill space, also FAC allocations that came in during the month helped to reverse the impact of this liquidity sterilization from the Central Bank of Nigeria. Now we saw that liquidity frequently ranged between 3 trillion and 7 trillion. And as of March 2026, we saw that it even went up to as high as 8 trillion naira. Now, looking at the short-term interest rates in the market, short-term instruments, the rates for the short-term instruments in the market, we had an introduction of the Nigerian overnight financing rates in the month of April 2026, and this became the new constant benchmark rate for these short-term instruments in the market. So instead of these inconsistencies that we've been seeing in the market, especially because of the fact that we've seen that liquidity has remained comfortably surplus in the first half of the year, we saw that the introduction of this rate has kind of helped to create a balance in the market. And since its introduction, because of the comfortable liquidity, we saw that the rate has been within the range of 22.0% to 22.06% consistently. Now, going into the second half of the year, we expect that the CBN will still likely continue its liquidity sterilization, especially because of the fact that we are seeing that inflationary pressures are beginning to get stronger. And in order to contain this, they will definitely want to step in to balance liquidity in the market. So we saw that this liquidity conditions translated directly into the treasury bills market. And this created a really strong demand from investors in the market. Now, let's look at what exactly happened in the treasury bills market, because we'll be speaking about liquidity conditions and how that seeped into the treasury bills market. Now, what exactly happened in the market in the first half of the year? So, in the treasury bills market, we saw that the benchmark yields really went high, like what we saw in the global in the global space. Despite the fact that we saw sterilization from the central bank through frequent OMO auctions, we saw that liquidity was still very sufficient enough to support strong demand in the treasury bills market. And this made the Nigerian treasury bill market to become one of its strongest performing in the first half of 2026. And now, due to this large system liquidity, we saw auctions consistently oversubscribed. We saw the DMO raising as high as 5 trillion, or even if not over 5 trillion in the market during this period. Also, we saw investors' preference largely towards longer tenor bills and papers, and this reflected investors' desire to lock in elevated yields in the market. They want to take advantage of these elevated yields in the market. So rather than going too long, they decide to go in for the longer tenor of this short-term instruments in the market. So because of this, we saw that stop rates gradually repriced higher, and by the end of June, we saw about 90 basis points increase in the stop rates to 17.34%, reflecting how strong investors' demand had been for the first half of the year. Likewise, in the secondary market, we saw really strong demand for longer tenor bonds, longer tenor bills, like we saw for the primary auctions, and this kind of helped to compress the yields that initially went higher in the primary market following these auctions. So going into the second half of 2026, we expect that, like I said earlier, liquidity will still definitely remain strong and robust. Increase in the government's borrowing requirements and also the continuous issuances in the primary market is expected to still keep these yields elevated in the treasury bill market. Now, still moving along the yield curve, the bond markets experienced a different dynamic from what we saw in the treasury bills market. I mean, with increased government borrowing requirements, like I mentioned earlier, we saw a gradual repricing of yields, especially during the second quarter of the year 2026. Now, saw in the first quarter of the year, we saw really strong auction participation, especially from the likes of institutional investors and pension fund administrators. However, by the second quarter of 2026, we saw that sentiments from investors shifted a little bit as the DMO increased its bond issuance level and also supply into the market. As of the first 3-4 months of the year, we were getting offers from the government to the tune of about 700 billion. However, as we got to the June, we saw offers increase to between 1 trillion and 1.2 trillion naira in the market. Now, the stop rates from this auction repriced higher as a consequence of the increase in the supply, as we saw investors are demanding for additional compensations for inflation and the increased supply risk in the market. Likewise, in the secondary market, we saw activities largely concentrated on up to 10-year maturities. And I mean between the likes of 2031 bonds to 2037 bond, we saw a bit of activity in that space. We also saw the influx of FPIs towards the end of June into the market because, I mean, looking at the foreign exchange, we've been seeing quite stabilization in the Nigerian currency for quite some time now, and that has really helped with the strengthening of the bond market. Now, going into the second half of 2026, we expect that the bond markets will still remain a little bit cautious and bearish as the continued increase in supply and also the resurgence of the inflationary pressure, especially from the surging energy prices, will still keep yields elevated. Now, to conclude everything that we've spoken about concerning the fixed income market, like we saw the first half of the year 2026 was really characterized by resilient investor demand. We saw really strong demand in the market. I mean, despite the challenging macroeconomic environment and in terms of the geopolitical risk and the surging energy prices. Now, looking ahead into the second half of the year, the direction of the fixed income market will largely depend on two things. Most importantly, inflation and the continuous stellarization from the Central Bank of Nigeria. Also, the government's borrowing requirements and foreign investor participation will likely continue to control the drive within the fixed income market. Thank you.
Thank you so much, Favor. We now know for sure that the market is still very liquid, and we can ignore the various activities that are being done to mop up liquidity and control the inflationary pressure so that these markets can still remain attractive. The opportunities you've highlighted certainly provide investors with compelling options to consider in this current environment, especially retail investors participating in the fixed income and money markets. So to our audience, please don't forget to post your questions in the Q&A tab. We will get to them very shortly. But now, let's turn to the equity market. Andrew, good morning. It's a pleasure to have you join us for this leg of the discussion.
Good morning, Oni. It's great to be here. Morning, everyone.
Good morning. So, Andrew, the global equity market has been nothing short of dynamic and very eventful, with investors navigating a landscape they haven't seen before now or for a very long time. Can we take a look at the global stock indexes and then swiftly move to Nigeria equity market, which has experienced some remarkable run over the past year? So we've seen increased participation by local investors, record-breaking performance on the NGX ASI, That's crossing 100 trillion mark, 100 trillion naira mark. Strong activity even on the NASD, and then we also saw periods of heightened volatility, particularly in June. So please help us unpack the key developments that have shaped the equity market so far this year, and more importantly, what should investors watch out for? How should they position themselves for the months ahead? What are the risks that they should be watching closely?
Okay, thank you, Uni. So the global equities market has really been dominated by the AI investment momentum that has been the dominant theme across the indices around developing, and emerging markets. So we saw the US market, the Nasdaq returned 7.1% within the period, the S&P 5.34, and the Dow Jones Industrial Index returned 8.9%, all on the back of increased AI investment, and then that's investor reaction to those increased capex on the artificial intelligence side on the equities market. Due to the Middle East tensions, also the central authorities were unable to cut rates because of the inflationary pressures that came from energy costs, higher energy costs. And as such, the equities market still remained attractive. So that has filtered through the developed markets. In Europe, we saw the German DAX is up about 20%, largely on the back of increased defense spending and infrastructure spend, given the current tensions between NATO and the US in terms of their ability to protect themselves, and whether or not the US would be willing to stand up with NATO if there was any external aggression. And that has forced individual countries in NATO to increase their defense spend, and that filtered to increased expenditure for the German economy, which reflected in the DAX as well. We saw a rate cuts across some European economies, which again helped the equities market. Emerging markets, Nigeria has really shined when it comes to performance among emerging markets. On dollar terms, the market is up 67%. In local naira terms, we are up about 47% with respect to the index, and that performance has made it one of the best performing, index across global indices. Asia saw again riding on the back of AI investments, semiconductor production, and the rest, and then some government stimulus also saw their markets return. Post attractive returns for the period. The Japanese Nikkei returned 22.41%, and the Shanghai index returned 3.2%. So performance globally has been very attractive for the global equities market. Locally, like we said, we are up 47%, and though the top 10 gainers was dominated by penny stocks, the blue chips also posted attractive wins within the period. The oil and gas index was up 90% within the period, and consumer goods was up over 70%. The main drivers for the local performance that we have seen include what we saw with pensions, the revision of pension investments in the equity space, the upward revision of pension exposure to the equity space. So a lot of liquidity flow into the equities market. Then we also saw robust earnings from full year 2025, and dividend payments. All those fed into the equity space. The removal of Nigeria from the Financial Action Task Force grey list also sent positive sentiments to the market, especially to foreign investors. We've seen the accretion in our foreign reserves, which communicates confidence to foreign portfolio investors. And so we've seen increased participation of FPIs in our markets, even though the locals, both institutional and retail, have held the market very well. But that attraction of FPIs has also helped us. In April, we saw the extension of the trading hours of the NGX by 1 hour 30 minutes till 4 p.m. from an initial 30 p.m. stop period. That has seen increased activity and has given more investors, especially FPIs, they have a longer window into our own market before their own markets their own markets begin. So a mix of all these factors, without forgetting the impact of the announcement by the FTSE Russell index that the inclusion of Nigeria into the index was being considered, although there was subsequent information that because of the T1 settlement cycle, that is still under revision. But S&P 500 has also come out to say that in 2027 we should be looking at the inclusion of our index into the global index. All these factors have helped to push the market to a return of 47% that we've seen. Though the month of June, which closed out the half-year period, was negative, we're down about 8.3%, but that was largely because of profit taking that we saw earlier in the period, and then the introduction of the T1 settlement cycle unsettled the foreign portfolio investors who have to recalibrate their custodian operations to be able to accommodate the new settlement cycle. Then the drop in oil prices when we saw the near resolution of the US-Iran war also sent some, jitters down within foreign portfolio investors, because the level of our foreign reserves determines the FX stability locally. So those are the factors that have pushed the markets higher. Next. So this just shows the return on a monthly basis. January, February, March, May, April was up 20.36%. We saw the insurance increased, the boost in corporate earnings and the impact of the released dividends really impacting the market at that period. The likes of GTCO and Access dividend and Zenith, the dividend declarations were above market expectation, and so we saw increased positioning in that space. Next, please. Okay, for our outlook for the second half of 2026 and the key drivers that will do that. So typically, the market trades on a cycle, on a traditional cycle. Q3 usually dominated by mixed trading sentiments because it's holiday season and we are coming from the high of Q2, reaction to corporate earnings and dividends. So we usually see a lull in Q3. The last 28 years, on the average, the months of July, August, September have returned negative. We do have specific periods where there were extraordinary events around that period that forced a positive return. Like in July 2025, we had the GTCO secondary listing on the London Stock Exchange, and so that attracted a lot of interest in that particular stock and other banking stocks that were expected to follow the same line. And so GTCO crossed 100 at that point, and the index it pushed the index higher. So we saw a 16.6% return, but the months that followed that were typical of Q3. Going into the Q4 2025, we saw increased interest after the rate cut by the CBN, and then investors positioning ahead of the Santa Claus rally that is expected in Q4. 2025 also, the end of 2025 also saw the capital gains tax reform announcement, which led to a dip just before the close of the year by foreign portfolio investors as to whether or not the level of taxes that would be expected of them to pay. Going into 2026, the second half of 2026, we expect the law to continue with mixed trading until we get to towards the end of August and then early September, where we will see the listing of Dangote Refinery, which we expect to significantly impact the all share index, even though some selected stocks might suffer as investors rotate out of those particular stocks to make liquidity available for the Dangote Refinery IPO, and that may impact the oil and gas space. Post the Dangote Refinery listing, we expect a rally in the stock price, and which will also drag the entire index along with it upwards generally.
Thank you, Andrew. Thank you so much. It is remarkable to see how the market has evolved. You took us bit by bit from 2025 to where we are today. And we definitely cannot ignore AI's contribution in all of that. So while many sectors have declared impressive returns, we cannot ignore the risk. And investors still need to stay disciplined, informed, and cautious. But let's make it a bit practical for the audience. Based on the current market environment, where do you see the most promising opportunities? What sectors or asset classes should investors be paying close attention to? And how would you recommend they allocate their portfolio over the next few months?
Asset allocation, portfolio construction, like I said, we are heavy on the equity space. We would go with about 50% in equities for the sectors that have been highlighted. The money market space with yields from treasury bills to commercial papers ranging between 21 to 24.5%. That is still attractive. Then for diversification and stability, the fixed income space, we are looking at allocating about 10%, especially to high quality corporate bonds. And the alternative space also, that's for commodity trading, real estate, and private equity funds. We would also see about a 10% allocation to that space. And then cash of about 5% for liquidity and opportunistic plays, such as the coming down with the IPO. So that would be our recommendation for asset allocation portfolio construction.
Thank you so much, Andrew. Thank you for that. I mean, I hope somebody was taking notes because this is one of the ways you can allocate your portfolio. And without further ado, let's move on to my favorite session, the question and answers. You've heard all our speakers have to say, Jonathan, Favor, and Andrew. And I do have questions of my own, but so the audience, if you have a question and you'd like to speak, you can do so by a show of hand and we will unmute your microphone and you could ask your question to any of the panelists. But let me ask this question to you, Andrew, just because we just had that conversation now while we wait for the audience to drop their questions in the box or do a show of hands. We've heard the allocation, just something that in my line of work, advisory, that deals with clients. A lot of times we hear the positive sentiments around the equity market. So a 45 to 55% allocation, some investors can see that a bit concerning, especially with what is happening in the market, just coming out of the volatility in June, and not too sure that the rest of the year is going to be stable. It's been a surprising year for the equity market all through. So if we're thinking about FTSE Russell's hold on listing Nigeria in the frontier market from an unclassified market status, we think about the NGX new anticipated 3-tier pricing for units, and we think about the new stock listing that everybody is anticipating. What time exactly would it be good to get into the equity market? Because we're sensing that this is going to make the market very volatile. Our investors supposed to come in now, early Q3 or Q4, and really, you said that the Santa Claus rally will still happen, but with all of these dynamics and seeing that the world is not what it used to be anyways, rewards and all of that, do you really still expect the market to follow this trend?
Okay, thank you, Oni. So with regards to the time to come into the market, experience has shown over time that timing the market doesn't really pay, especially for individual investors. It is better to be in the market. What we would advise is entry into the market. Where we are currently in Q3, typically there will be mixed sentiment. So we see the market returning gains and losses, on a day-to-day basis, and that is where investors really come in and pick at those prices. If we look back when we get to the end of the year, we look back to July to look back to where we are now, we'll actually see that prices are trading at low PE levels and attractive entry levels for investors that want to position. The next major event that we're expecting will be the release of corporate earnings. We expect those corporate earnings to be improvements on the corresponding periods of 2025. So that would feed investor interest. We would see the listing of the Dangote refinery, positioning for Santa Claus rally, and then so we expect the all-share index to trend upwards. So where we are currently is actually a good position to start entering into selected names in the market, not just although we expect a broad positive participation, positive return across sectors, apart from the two highlighted. But a phased entry into selected names is advisable for individual investors. So where we are is a good time to start positioning the equities market.
Okay. Thank you for clarifying that and for giving us that green light. We have a question in the Q&A session. A couple of questions asking about the recorded session, the slide. Okay, that will be handled by the admin of this session. But Mr. Kazim Koleosho says, with the significant uptake on the private placement for the Dangote refinery, is there a possibility that the buyers will do a dump post-IPO in September for the stock? This is similar to what I asked for. Andrew, if you could also... the concern is investors dumping other stocks just so they could position for this stock in September, before September.
Okay. So if those that participated in the private placement would dump when the offer opens, so there was a lock-in period for the private placement investors, over 1 year lock-in period. They will not be able to sell, when the IPO opens. So the fear of a dump would not be there, and that's why we are confident that we will see a rally in the price post-listing. There's a lock-in period for private placement investors. They will not be able to exit until after a 1 year period.
Okay, thank you so much, Andrew. Mr. Kazim also says thank you. We have another question that says, considering the current valuation and the expected Dangote refinery IPO again, where would you advise a first-time investor to deploy fresh capital over the next 6 to 12 months, and why? So maybe this question needs you to answer on a broader frame. I'm not thinking the investor is referring to only the equity market, but you could streamline that to the equity market, or generally, where should a fresh or first-time investor deploy their capital?
Okay, deploying capital over the next 6 to 12 months for fresh investors, it really goes down to like an investor profiling. For the individual investor, we need to know the specific profile of that investor in terms of their risk profile, the nature of funds that are to be deployed, the tenor of that particular investment. So all of that needs to come into play before a proper tailor-made recommendation can be done. But on a general note, like we mentioned, we are overweight, we are bullish on the equity space. The oil and gas space, industrial goods, the banking sector, we are bullish in that particular space. And then for high quality money market instruments, commercial papers with double A ratings, high quality commercial papers with yields of up to 24.5%. We are looking at a 12-month period. So that is one place. Those are the high quality CPs, moderate risk. And then for the equity space, over the next 6 to 12 months, we expect, or even to be more specific, the next 6 to 9 months, we expect an upward trend in the equities market. So that is something to consider. But it will be better to sit with one of our advisors to get a proper investor profiling to get a customized solution to them.
Okay, thank you so much, Andrew. And honestly, it's almost all the time that we have for today. I will just respond to one of the questions about recommendations for the stock market with a promise. Just to clarify, recommendations they are not a guarantee. If you could back me up there, Jonathan, they are not a guarantee for performance. They are only a recommendation based off on technical and fundamental analysis. So if we all could see the future, we'd all be billionaires. I promise. I'd make everybody a billionaire if we could tell for sure what the future will hold for each stock. We'll definitely all be billionaires. So thank you. That is all the time that we have today. But from everything that we discussed today, I just like to still reiterate that something clearly stands out, that information is the foundation for decisions and successful investing. And every investor's financial journey is unique, but having the right partner can make all the difference. At FCSL, we are committed to being that trusted partner. FCSL is duly licensed by the Securities and Exchange Commission of Nigeria to operate as an issuing house, a broker-dealer, and a fund and portfolio manager. Simply put, FCSL is well positioned to be your anchor and advisor in the capital and money market by creating investment opportunities, providing expert advisory services, and helping you navigate today's ever-evolving financial landscape. Andrew, your hand is up. I don't know if you'd like to say something.
Okay, yeah, sorry, just to respond to one of the questions concerning the recommendation on UBA. So our recommendations are typically for a 12-month period is a 1-year target price. And I'm sure that that investor would testify that we've seen appreciation in the share price of UBA. So it's a 1-year target price. You cannot judge the performance of a recommendation over a number of weeks or a couple of months. The valuation takes into account returns of that company for the subsequent quarters. So you're looking at a 1-year target price for that recommendation. It's not a short term. We do have short-term recommendations that are for proprietary trading, but individual investors, it's better you take a longer term horizon view to the equities market than just a couple of days or a couple of weeks. Thank you.
Okay, thank you, Andrew, for just adding on to the back of that. Definitely, our recommendations do already state that we're recommending for you to hold from 6 months to 1 year before you might see some reasonable returns. So as we wrap up today's webinar, I'd like to extend my sincere appreciation to our speakers for sharing their expertise and valuable perspectives. And to everyone that joined us today, thank you for taking time out to be a part of this conversation. Today, we explored the forces shaping the global economy, examined Nigeria's domestic economic landscape, and we unpacked the opportunities, risk, and outlook across the fixed income, money, and equity markets. We are reminded that every market cycle brings both challenges and opportunities. Thank you once again for joining. We look forward to connecting with you at our future events. You can connect with us through our various channels on the screen. You can follow us on Instagram, LinkedIn, Twitter, TikTok at FCSLNG. Until then, stay informed, stay invested, and have a good afternoon. Goodbye, everyone.
Goodbye, everyone.